Welcome to this session of strategic financial management, and we were discussing regarding optimum capital structure. Now, discussing regarding what are the things that are to be discussed under optimum capital structure, and some of the things that we discussed I did not mention, wherein which it would be helpful for you making some kind of points. So, what you can take down is that now there are theoretical relationship. So, those who want to take down can take it down. There are theoretical relationship between capital structure, cost of capital and valuation. Now, all this show that although the empirical evidence is not conclusive, theoretically, a judicious combination of debt and equity does affect the cost of capital and also the total value of the firm. The capital structure is said to be optimum when the marginal real cost of each available source of financing is identical with an optimum debt and equity mix. The cost of capital is minimum and the market price per share is maximum. Moving further, what you can take down is the use of debt in capital structure or financial leverage has both benefits as well as costs. While the principal attraction of debt is the tax benefit, its cost is financial distress, and reduced commercial profitability. Moving forward, you can take down the meaning of financial distress. Financial distress includes a broad spectrum of problems ranging from minor liquidity shortages to major ones such as bankruptcy. The problem of financial distress will magnify with an increase in financial leverage. Beyond a certain point, the expected cost of financial distress will outweigh the tax benefit. A firm is thus concerned with a trade-off between risk and return arising from the use of debt. A proper balance between the two is therefore necessary. Continuing, what you can take on this, maybe you can start within next line, maybe next paragraph. Given the objective of maximization of shareholders' wealth, the need for an optimum capital structure cannot therefore be overemphasized. In operational terms, every firm should try to design such a capital structure. But the determination of an optimum capital structure is a formidable task. It should be clearly understood that identifying the precise percentage of debt that will maximize price per share is almost impossible. It is possible, however, to determine the approximate proportion of debt to use in the financial plan in conformity with the objective of maximizing share prices. So, having taken down all this, next you can speak regarding the optimum capital structure. How is it in practicing? How is it in practice? How difficult it is to design one? Because the main reason is that there are different theories given by different people, and also that not only regarding the theoretical version, in practice also, you know, there are several kind of industry, and even when we speak of industry, within the same industry, the organization which are set up, they would be different in respect of capital structure. This is with the main reason because there are, you know, different factors, both in terms of quantitative factors and qualitative factors, which calls for subjective judgment of financial managers. Now, having said this, we shall see once again what are the things that we discussed under optimum capital structure. That is, in every firm, the financial manager has to come up with optimum capital structure. Optimum capital structure is that capital structure at that particular level of equity and debt proportion where the market value of per equity share is maximum and the cost of capital is minimum. The study of capital structure always involves decision about the nature of the industry and the specific circumstance of the business enterprise in person, besides the general theory of business. Now, it is difficult to define ideal capital structure as it is the function of nature of its business and how risky the particular business is, and therefore always a matter of judgment. And Van Horn has given the definition which states, in the optimum capital structure, the marginal real cost of each available method of financing is same. Now, having said this, let us move forward and see that there are three circumstances under which there can exist what is being called as optimum capital structure. Now, the first particular situation is wherein the total value of the firm is maximum when its equity stocks values at the maximum. Now, This is the first or the main situation wherein we tell optimum capital structure is possible, wherein we have the value of the firm is maximum and the equity stocks of that particular organization is also maximum. Now to have such a particular situation, there are some of the assumption made, that is to tell, debt and preferred stock never affects by fluctuation of market and they remain fixed for all the time. But then equity fluctuates with profit of the firm. Now both the firm and equity should be maximum under such circumstances. Now the second one is the equity stock value should be maximum on a per share basis so as to ensure the optimum capital structure. Now this is to tell that now under the first situation we said the value of the firm should increase and also that the market value of firm should be increasing. But then what we have to remember is the value of the firm can be increased by increasing the equity shares. But then what happens is that under such circumstances the per share value of the organization is definitely going to get affected if at all the return is not same as the value what has been increased. Therefore, under second situation, they are telling that the equity stock value should be maximum on a per share basis so as to ensure the optimum capital structure. Now, under third situation, the optimum capital structure of the firm's overall cost of capital is its lowest. Now, this is which is described in terms of the link between the cost of capital and optimum capital structure. So, the three different situations are: first one, the total value of the firm is maximum when its equity stock is at maximum. The second one is the equity stock value should be maximum on a per share basis so as to ensure optimum capital structure. The third one is the optimum capital structure of the firm's overall cost of capital should be at its lowest. Okay. Now, we shall try to understand some of the features of appropriate capital structure. Now, it is very important to have optimum capital structure for any organization. Now, the value of the firms depends on the way a capital structure is built, and also the manager should develop such a capital structure wherein the maximum of share wealth is done. Now only when all these factors are properly analyzed and considered, only then a balance between appropriate capital structure is possible. Generally, it is planned and keeping in view of the market or the preference of the shareholder, and also other internal factors are to be, and the government intervention, all these are to be considered while coming up with the optimum capital structure. And all this it is said because for each organization, optimum capital structure we can tell in terms of theory what it is, but in terms of the value it can never be tailor made. Now each business are to be analyzed in terms of its nature, how risky it is, what are the specific nature in which it is right now currently working, and what are the factors that are to be considered, maybe in terms of what the shareholders expect, what is the government intervention, and other such consideration. Now, speaking about profitability, profitability is the one thing which is most advantageous, or which is also most preferred. That is to tell the maximum use of 1 rupee at the minimum cost possible. Or in other words, profitability tells that every 1 rupee that is being invested in an organization, or for that matter any currency that you can, 1 rupee, $1, or anything that it is, should generate maximum return without adding additional cost to it. The next one is solvency. Now, speaking regarding solvency, excessive debt always threatens the existence of the company. Now, the debt should be used till a point where the debt would not be increasing any significant risk. And if after that particular point, when the organization is finding that the benefit that is raising because of using it is being outweighed by the cost and the risk of using it, it should stop avoiding debt in its capital structure. Otherwise, it might result in bankruptcy and also the solvency of the organization. Now, the next one is flexibility. Flexibility is nothing but change according to the situation without increasing any other cost. Okay. Now, this is the talk of the hour, this is the need of the hour. No matter what optimum capital structure you have today, because of something has changed in your business or environment, for tomorrow that optimum capital structure might be proving wrong for your organization. Hence, a capital structure of an organization should be built in a very, very flexible way. Now, here when we speak about flexible, it should be such a situation wherein change that is necessarily to be taken should not be increasing any cost for the organization. And also, it should be possible for the firm to provide funds where needed to finance its possible activities. Now, firms also should be able to repay funds if it is not required by the organization. So, hence all these things when we discuss, it goes without telling that capital structure or coming up with an optimum capital structure is definitely not a easy task, or for that matter it is very, very complex in nature. Now the next feature is conservation. Now speaking about conservation and capital structure, it is said that with the debt in the company's capital structure, there would be something called as debt gap, which generate future cash inflow. Now it should have enough cash to pay its fixed charges and also the principal amount of such debt. So there has to be some conservation which has to be made when an organization goes in for debt as its main source of capital fund. Otherwise, as we discussed earlier, it will only lead to the bankruptcy of an organization. Now the next one is control. Now speaking about this control, there are chances that yes, when we have only debt in our capital structure as the source of fund with which organization deals, the entire control would be in the hands of the management. But as the organization goes more and more for equity as its source of fund or in its capital structure, definitely the ownership would be distributed among all the equity shareholders and it might result to loss of control. Now having mentioned this, there are also general and in particular features which may be additional or which might helpful in future weightage of or each of these features, and definitely all these features would be different for different firm. Now there is some of the things which a financial manager has to consider while he comes up with what we call as optimum capital structure. The first one is return on investment. Now return on investment should be such that now this should raise fixed cost sources of funds only when return of investment is higher than fixed cost funds, but it should also be conservative. That is to tell, what a financial manager should consider is that he can go with increasing the debt sources of funds in the capital structure only when he know that the return of investment is more than that of the fixed cost funds. Otherwise, it might be proving wrong for the organization. And not only that, it should also be conservative. The next one is tax benefit. Now this is the main thing every manager has to consider. Now you have an option either to bring debt or equity. Now first thing you would consider is what is the tax that I have to pay. Now that if I pay tax, will it be more helpful, or if I go in for equity and not pay tax, would that be beneficial for my organization? Again, having said this, it cannot be done to a precise point, but only based on the past data, our particular judgment and the future way or the future trend that has been percepted, we can only do judgment on how things could go. The next one is perceived financial risk. Definitely we speak of perceived financial risk because in exact terms we cannot tell what would be the risk. Again, in again we cannot tell in clear terms whether we can have profit. Even though we tell profit, then we should remember the market circumstances. Having said all this, for this particular session, let us wind it up here for our